To be very frank, I was not excited about what the positioning of banks was, let's say in September and October. But their ability to raise capital and their ability to even withstand the entire COVID shock has been quite strong. But I guess the financial space is one space where consolidation is happening and consolidation will continue to happen. I will not say anything new or valuable if I say that lion part of the new deposit growth now is going to private financials. The question to ask Abha, I guess now is that what will continue to outperform? Over-owned, expensive, good, well-known franchises like Bajaj Finance, HDFC Bank or Kotak Mahindra Bank, or somewhere markets would say the gap between, let's say, an RBL and a Kotak Mahindra Bank, or a gap between a Federal Bank and a HDFC Bank is so high that it makes perfect sense to come down the ladder if you really have a constructive view on the economy and if you feel economy will make a comeback. I genuinely feel that while some of the financials, they will offer you good trading bets because of the valuation difference, ultimately, both in terms of technology, reach, in terms of brand, in terms of a deposit franchise, the growth is somewhere else. I mean, look at the growth HDFC Bank has reported in this tough quarter. Look at the growth what Bajaj Finance has reported. And I think markets will soon start valuing them as platform companies, which is what is happening. So the folks who've understood that Bajaj Finance is a data-driven NBFC, for folks who've understood that HDFC Bank today, just go on the website of HDFC Bank and what does it say? Borrow, save, shop, insure. That's what you need as your basic need. And HDFC Bank in a sense is trying to give you everything what you need. If you take that view, then you have a different view about some of these banks and franchise. But if you take a view of 4-time book, 5-time book, then you may be completely foxed by what the markets and what other banks have to offer. But I've got a perfect guest who understands valuation much more than anybody else, Raamdeo Agrawal of Motilal Oswal Financial Services. Mr. Agrawal, good morning. Thank you for joining us. Before we start our today's interaction, let me extend season greetings to you on behalf of ET Now team.
Yeah, thanks, Nico, and very good morning to you and all the viewers.
So let me guess, are you still at Ambi Valley or back to Bombay?
No, back to Ambi Valley. So I just came 2-3 days back and I'll be there for the year end.
Wonderful. Now, we all know what the year has been, Mr. Agrawal. It's a year where I guess for an investor, we can use all the possible paraphrases and emotions which are there on the street. Fear, excitement, FOMO, dead cat bounce, panic, value, and now euphoria. So what is next in 2021? Which emotion do you think will be the dominant emotion for next 12 to 18 months?
Typically, day is followed by the night and night is followed by the day. So we have seen the nightmare of first quarter of last year when COVID turned out to be the biggest risk nobody ever thought. So I would think that just by statistically, next year should be a year of greed, or it should be a year of a clean performance, building on the back of debacle which we saw in 2020. So next year should be the year of, not as big a performance from bottom, but clearly it should be the year of building up on what a momentum economy has built right now.
We were discussing just before we came on the call, Mr. Agrawal, that 2020 in a sense has been a year where a new category called Robinhood traders have taken a birth. And now this is a formidable category. Robinhood traders, both locally and globally, are active. They love to understand technology. They're very swift and they're committing a lot. What do you think this means for the market? Because while institutional or domestic institutional investors are facing the heat of investor, but the retail activity is at an all-time high.
Yes. What it means is that there will be far more emotionally unstable, I would say. There will be more day trading type. There would be people who will be taking profits very quickly. There will be people who will be booking losses quickly. And there will be fearless in terms of in terms of where the markets are going. So they don't have experience of the past. That's the biggest asset as well as liability. So I would think they will bring a lot of volatility and a lot of depth in terms of liquidity on various counters. But otherwise, I think the direction of the market is not going to be decided by them. My sense is the individual stocks will be valued more by the price, more by individual large investors and determined investors and calculated investors. They are going to decide the price levels. But in terms of volatility and volumes, that will definitely belong to the so-called new age traders.
Let me ask a question which, in a sense, you as an investor represent, and your AMC is something which is built on the ethos, value investing. Now, value has a lot of definitions. Some would say below book is value. Some would say future growth is a value. In your mind, where is value in the market? I'm not talking about valuations in terms of traditional P matrix or price to value matrix, but value is something which you see right now is, and it could be, unlocked going forward. So where do you see value in this market?
Yeah, see, Nico, value is in the mind of the person who is practicing it. So in my mind, it is a very narrow part of the market. Like I see, I try to value a price, very small portion segment of the market, what is called quality and growth. So, so that's where I try to seek my valued stocks, and in which value means growth is very important part of the value, apart from profitability, high growth, and reasonable valuation. That's a mantra for our kind of stocks. But there are various pockets of values in the market. There's always, globally it has happened. So-called growth stocks are at all-time high, and value stocks are at all-time low. So we have our brand of values across in the market, particularly led by non-financial PSUs. They are kind of beaten down to very low levels. So clearly there is a deep value out there. But do we have courage to again commit there and make some money? See, clearly if your horizon is 1 year or 2 year, definitely look at these kind of companies also, because they are trade. They are not investment. They are not long-term investments, but they are the trades. So, the value for that limited context is clearly found in various pockets. But for people like us, I think we are looking at quality and growth, and there, in some cases, yes, you do find values, and that's where we kind of park our money.
I'm going to work with an assumption that vaccine is round the corner, and a lot would change in terms of human behavior, travel, basic approach towards life in 2021. If things normalize, let's say towards the second half of 2021 because of vaccine locally and globally, is it a good time now to play or invest in the COVID trades, real estate, maybe hospitality, aviation, multiplexes?
Yeah, one of the things I will tell you about COVID is that COVID peaked out. See, what is important is not so much the real business on the ground, but what is the opinion about it, the fear. The fear peaked out in March itself of 2020, and that's where we made the bottom of the markets. So right now, the fear about COVID, despite vaccines some time away, is much, much lower. So I would think that, yes, vaccines are being rolled out all over the world. The cases, at least in India, has come down to less than 300 or 250 deaths per day, which is kind of, and even the positive cases are just about 90,000 and dropping very, very quickly. So I would think that bulk of the COVID physically has been contained, at least in India. And the fear is also at all-time low. So now what we should buy is dependent on where is the franchise, where is the solidity. Because of this COVID thing, if there is a mispricing of the companies which you think has to come back or will come back, and they have the strength to make money in the future, I think you must buy it, even if the entire rollout becomes a little delayed. The issue is that whether these companies which have been beaten down, a lot of these companies are going to, maybe they may not be able to come back ever and give the market share to some winning companies in the sector. So I would think from those sectors, you must buy only the eventual winners.
If you have to take a guess on where the outperformance will come from for the market within financials, will it still lie with the good old HDFC and Kotak banks, or now the relative case for an RBL or Federal Bank or IndusInd Bank is so stark that you cannot ignore it?
See, the rising boat lifts all the boats. The rising tide lifts all the boats. So clearly, none of the guys, even including the public sector banks, will remain unaffected if economic peaks momentum at about 7-8%. Like next year, it is predicted to be anywhere between 10 to 15% kind of GDP growth rate. And if government is able to come out with fiscal measures and keep the monetary policies the way they are, and they are able to build on to that, I mean, in 2021, 22, of course, will be a big year, but drawing from there, if it is used, this crisis is being used to again align and build on that particular momentum. So clearly, and I see a lot of initiatives, a lot of thought process, a lot of announcements which are onto that. The PLI schemes and other things which are coming up. They're not for 1 year, they're for 3 years, 5 years. So the momentum is being built. And if that continues, then, all the weaker banks and smaller banks, they will also have their kind of bright times. And I'm sure these banks will also do well. And since they are beaten down so much, I think percentage rise could be quite high. But, if by chance the economy fails, then these banks are very vulnerable because their margins are very small. And the credit cost, when the economy slows down, the credit cost spikes. And we have still not seen the final verdict in terms of what is going to be the credit cost. So one has to be very cautious, particularly when you buy a lender. Lender has to be a pristine quality. And lenders have been tested in last 12 months. In last 12 months, the verdict is out clearly. Who are the guys who can really sustain the turbulent times in India? And India has disproportionate share of turbulent times. From various sources, it keeps coming to the businesses. So I would think you have to be very careful. The real place to buy, what I would say, deep value may not be lenders, but other than that, the kind of the cement, the steel, or some other cyclicals like automotives, auto components. Those are the places where you should definitely try your luck because those businesses are not leveraged. Whereas the banks, if they are not if they are not very competent and also leveraged, they are leveraged 8:1, 7:1, and then on top of it, they are not competent. I think that will be a dangerous place to put your money. Of course, you can have a cyclical ride, but I think that's a very risky ride.
Do you think autos at best could be market performers? Because globally everybody is talking about innovation and disruption in the automobile space, given what the market cap of Tesla is. And we know what's happened to Tesla's market cap if I compare it with all other auto companies. So do you think that is going to be a restrictive factor, at least for Mahindra & Mahindra and Maruti for next couple of quarters?
I think if at all it is a decadal call. I mean, what Tesla will do or Tesla brand of businesses in the sense that all the electric cars, will the migration from IC engine to electric will belong to the new company? The issue is not about migration. The issue is who is going to be beneficiary of the migration. Are the existing players capable of coming out with the products which are going to be far more compliant with the new environment? So I think for any automotive trade, you also need distribution, servicing, whole lot of things. So it's just not about and in any case, it's a more of an assembly operation today. So I would think that the future belongs to all the established auto players today here. And of course, one or two new players like Tesla will also come in. So I would not write off the current players just because the IC engine is going to come with new players. I would think that even existing players will come out with their brand of electric vehicles.
The only way to invest in technology in India is that you buy the good old TCS or Infosys or both. Some would say we can add in a Wipro. But given that of late, a lot of new niche technology companies have found their way into the market, and hopefully more will see in next 12 to 18 months. Are you a buyer in any of the niche technology companies? Because that's where all the excitement, euphoria, growth, and even investments are happening.
Yeah, I think I'll be open to it because in 97, 98, when the IT Indian this Indian IT services companies were coming, they were against IT companies, technology companies. But we were quite open to it. And wherever I see high quality franchises with high growth, I'm willing to try to understand the businesses and definitely open to investing. So clearly, yes, the new age digital companies. If you look at China, today top 25 companies, at least 17 to 18 of them are digital companies or digitally, digital prowess has been exploited. So I'm sure in next 5-10 years, this digital companies, which might be very small today, maybe 50 crores profit, 100 crores profit, or not making profit at all, because it doesn't take much time for a digitally empowered business designs to become very, very large. So I would be very open to it, and we should have a little patience. But yes, it will be one of the new sources of great ideas in the years to come.
You mentioned PSU stocks, and looks like government this time is quite committed to at least roll the disinvestment process on BPCL, Concur and SCI. If in next 3-6 months a large disinvestment goes through and a good one, a strategic stake sale, not like HPCL and ONGC or PFC and RSC, a genuine disinvestment goes through, do you think that could be a complete PE re-rating moment for lots of PSUs?
I'm quite sure the ones which get disinvested, they'll definitely get re-rated. One, because of the bid price itself, because the buyback and other things might come. And second is more importantly, the change of the management. There will be predictability of the franchises are fantastic, but the management actions have been unpredictable in the past. So there will be an entrepreneur, there will be a private sector corporation, hopefully a good one. So they will exploit the resources or the infrastructure which the PSU companies have built over the last 3-4 decades under their belt. So, in fact, some of them after privatization will be a fantastic investment once you look at who has got the company.
What future returns do you think investors should expect from some of the master franchises? Asian Paints, Nestle, Pidilite, fantastic businesses. Can they give double-digit returns from here in next 2-3 years?
Yeah, shorter the period, difficult is to predict, but I think if I would only say if economy does about 7-8%, then these companies will do much better, like more like 18-20% also. But if economy remains in slow mode of about 4-5%, then I would say that even these wonderful franchises, they cannot create opportunity on its own unless the economy grows and the respective sectors they really throw rapid opportunity. So I would think that 10-12% would be in a situation when things are very, very slow. But otherwise, as a whole, I mean, one company could be different, but if you buy a bucket of 10-12 companies of this genre, I think you should expect 10-12% return from these companies.
Fair point. What, to your mind, are the 3 large pockets where you see the size of the opportunity is very large and it could grow at 15-20%? I'm using a word from one of your wealth creation studies, value migration. Where do you see 2 or 3 pockets of small, strong value migration?
Yeah, 3 large pockets of value migration is one, of course, is IT, which is mother of all the pockets. And now, I think the COVID impact on IT is still not understood fully, or it is not. I mean, you see in the years to come how this has changed completely the opportunity set for the existing software companies, services companies out of India. for various facets. One, the pace at which people, the corporations, they want to digitize their operations. Second, I think the work from anywhere would also change the entire cost structure and the possibility of whom you can deploy and where they can be sitting. So I think a lot of these things will have impact in terms of the scalability and the size of opportunity and the pace at which this opportunity will be exploited. So I would think that it's a post Y2K. We had seen, 15, 20 years. I think this is Y2K too. I would say this is a moment when IT services will gather momentum in terms of migration. You're seeing the size of the deals which are happening. So I would think that this is one sector which will continue, and next 5, 7, maybe even 10 years, this will be a big time for them in terms of growth and quality of growth. Second, I think public to private sector bank. So in last 15, 20 years, public sector bank has given about 1/3 of the market share to private sector. And I believe right now, as we go along, the incremental market share is upwards of 2/3 for the private sector and 1/3 for the public sector, till they get recapitalized or change hands or whatever. So my sense is the pace of loss of market share by public sector to private sector will be extremely rapid to the capable banks in next 5 to 7, 10 years. So this is going to be another big one. Third will be your telecom. Telecom, the pace of telecom earlier from fixed line to cellular lines, wireless lines, and now from wireless conventional cellular phones. Now you're going to internet-based phoning, data-driven kind of telephony, where minutes don't matter, only data matters. So I think this is going to be one consumer-facing business, which is very large, growing rapidly, and yet the industry is not making money. So I hope the internal fight or that is settled, and just about 3 players are left, and hopefully the leader and number 1, number 2, they decide to make money, and because their capital deployed is staggering. Almost 10 lakh crores or maybe even more than that, and they barely make any money. So I would think that of the value migration, even this third bucket should do very well. And then you have a broad-based lot of businesses from a conventional model, they are going to digital models. And that's where, like what you saw in Bajaj Finance and all, they are doing conventional business, but with the help of digital engine. And that's where I think most of the surprises will come. So we will keep looking for the spots where migration is happening very, very actively and efficiently.
Okay, QGLP. That's the formula, that's the matrix in which Motilal Oswal Financial Services invests. We've discussed Q, which is quality. We've discussed G, which is growth, and we've discussed size of opportunity, which is longevity. Now let's come to the price. And first, let me use the Nifty benchmark, Nifty benchmarking to establish this point. You always said that the entry point is a factor which will determine your future return. So for those who are planning to invest now, or are, let's say, invested, some would argue that valuations are at an historic high, at least for Nifty. So the future return should not be very high. How would you counter that? We'll try and get him back. Very important to understand the aspect of price. You can buy great companies, but if you buy them at prices where 3, 5, 10 years of growth is factored in, trust me, you're not going to make return. We talk about this classic example of HUL that, between 2010 and between 2000 and 2010, it never gave any returns. Similar example can be established for, let's say, Reliance. Between 2009 and 2013-14, it never gave good returns. Are we likely to go through that patch of flat returns for a lot of stocks which have given gangbuster returns in last couple of years? Let's say Bajaj Finance or an HDFC Bank. Okay, Mr. Agrawal, price. If I look at estimates for FY22 and FY23, and even for Nifty, it is trading above its historical benchmark. So for those who are planning to invest now or are fully invested, should they not expect good returns because your entry points are not great? He's in Ambi Valley, guys. He's in Ambi Valley. If he's in Ambi Valley, you could blame it on the link, and you could blame it on the fact that we all are working from home right now. So lots of cross connections may happen, but I promise I'm going to get him back. And my producer is prompting me in my ear that just bear with me for 30 seconds and hopefully he should be back. I don't want to miss that part on the valuation aspect. Like I was mentioning, that you could look at price as in benchmark of the future returns. But for future returns to come, if earnings are strong, then automatically the P multiple changes. So it's all about earnings and recovery. That's what I think we should focus on rather than looking at the absolute starting point. If earnings come, then the projections of EPS will change and suddenly the market will start looking cheap. So okay, he's back. Mr. Agrawal, let's take that point forward on pricing, entry points and the valuations right now, even for something like Nifty. I'll tell you what, let's take a break right now. We've just got him on a terrible ride. My apologies, but these things happen when you're working from home. Let's take a break with the news that markets are in fine fettle. 2.5% higher for Piramal Enterprises, 1% higher for Reliance. It's good going, at least for some of the Tata group of companies. And if I look at the screen, there's far more green on the screen rather than what we saw, let's say, same time last week.